You're delaying your enjoyment of life today for a promised tomorrow in the net worth versus cash flow mindset.
Most of us just don't know that we are playing the game against who we're playing and the way we're playing it. So it's really a story of ignorance. Nelson Nash's main principles that he added on later was to rethink your thinking and constantly be willing to rethink your thinking. You may think you know where you are, you may have critical thinking about things, but it doesn't mean it's right.
Simply put, they want your money for as long as possible on a systematic basis. And when it's time to give it back to you, they want to give back as little as they can. Do what the banks do, not what they tell you to do.
When a person thinks about their total compensation, it almost feels like your total compensation is more than your salary. Those benefits are part of your total compensation, but the corporations are getting a big tax break to do those things. It just shows how much manipulation there is between the government and the financial institutions who are tied together at the hip in many ways.
But why are we talking about Stockholm Syndrome? The reason is because when we talk about infinite banking, we don't get any pushback from the financial institutions. We don't get any pushback from the government. If you're playing chess, you're playing against somebody. Who are those big three on the other side of the table from you? The three big players that are sitting across the chessboard from you are broadly grouped as
Back at it. Good afternoon, Hans. Good morning to you on the West Coast.
Yeah, morning over here. How you doing?
Good, man. Good. Except for I injured my wrist falling down to try to do a push-up almost like a burpee. And so I can't do anything right now with my left hand. So that sucks. Fortunately, they don't ask you questions about that whenever you get underwritten for life insurance. I just put a new policy in place.
Nice. So yeah, you having a limp wrist didn't impact that.
Oh, not at all. No, I'm still good to go.
Nice. Well, my daughter's policy just got approved, so gonna have another banker in the family. She's 1 month old, so she's not quite getting it and not really pulling her weight yet, but looking forward to teaching her. And I've already decided of my two daughters, I think she's leaning more towards being an IBC partner down the road.
Yeah, good. So, yeah, you could probably tell by the way she sleeps and cries and poops her pants all day.
Yeah, exactly. Yeah, she's a natural. My other daughter is very creative, and I could kind of see her doing a much more creative work. But I've decided Talia is my analytical child. So
it's awesome. Yeah, she's got the ones and zeros figured out. She has you guys probably figured out to a T at this point. I do this, they do that.
Yeah,
that's awesome, man. Yeah, I just closed out another new policy on me, so that takes our entire banking system up to 12 policies now. I just keep expanding every time income increases, and every time I have money that I need to do something with. It's awesome to flow it through this system. So super excited I closed it out a couple days ago. I'm waiting for it to process. So it's still sitting. The money's still sitting in my checking account, driving me nuts. I want it to be in the policy, but any day here, hopefully by today.
It's just stagnant money. But putting it in these policies gives it potential energy. Basically, we're just storing it up and ready to deploy, but it's doing a ton of work. As soon as it goes in there, the most optimal place for any dollar to start out is an IBC policy.
Let's talk today about what we've labeled Stockholm Syndrome, and we give credit to like the LEAP system with this, with one of our coaches who's introduced us to that system, and really Bob Castellone, who wrote it, figured it out, and built it, and it's an awesome system that. Which we're not going to talk about LEAP, but what it is, it's a holistic plan. So it kind of shows you every possible thing in some way, at least through broad categories, what your money can do and where it can flow. And whole life insurance is a major player, and infinite banking, since we utilize whole life insurance as the best vehicle to take over the process of banking, fits beautifully within that system, and it helps you look at what else you should be doing with your money and where it should be doing. But so he's wrote a great book. He's built a whole system that is I don't know 50 some years ago that is still going strong. And so he's one of the things he talks about is the three big players. When you're in this financial world, you're not battling with, but you're playing against. I guess you are kind of battling with these three players that are on the other side of that financial chessboard. So Hans, go ahead and talk about that for a minute, and I'll let you roll.
Yeah, when we're talking through scenario planning and strategy using the LEAP system, we're looking at these places where you can think of it as the financial chessboard, all these places you can put your money. So moving, different plans, different financial products all have different functions, different things they can do. So the analogy to a chessboard is pretty accurate. And when we talk about reallocating cash flow, changing the sort of operations, as Trent, our mentor, calls it, the financial physics, you're moving these chess pieces, trying to optimize. But to flow that analogy further, if you're playing chess, you're playing against somebody. And so who are those big three on the other side of the table from you? And if every person in the economy is trying to optimize their chessboard, uh, we can either do it together in a manner that we try to do in the IBC community, where we don't focus on scarcity, we focus on abundance. But on the other side of the table, there is an industry. There's three large entities that are trying to do so, we believe, at your expense. So the three big players that are sitting across the chessboard from you are broadly grouped as financial institutions, the government, and corporations. So Brian, I'll let you pick up. Start with maybe financial institutions.
Yeah, before I do that though, I did want to mention we talked about LEAP, and I mean, what does that mean? It's actually just an acronym for Lifetime Economic Acceleration
Yeah.
Process. I want to mention what it means because people hear LEAP and it sounds like we're going back to Office Space. No, it was Jump to Conclusions on Office Space. Jump to Conclusions, Matt. Do you remember that?
No.
No. Okay. Well, anybody over 40 definitely will listening to this. All right.
I
Yeah.
definitely remember
So
Office Space, but I don't remember that quote. I'm
that's
not a
the guy
movie. I'm
who,
not a movie guy though.
yeah, I'm not anymore, man. If I quote movies, it's got to be prior to like 2004. But anyway, back to what we're talking about. So on the opposite side of that chessboard from you, the number one thing that we talk a lot about in infinite banking is the financial institutions. And and if you think about like the way that interest is calculated, and we've already kind of hit on this in a prior episode, but most every loan you take out there, for example, is an amortized loan. And so if we look at the volume of the interest, it's way more important than the rate. And Nelson studied this, and it's in Becoming Your Own Banker, that on average, the average American family sends 34.5% of their money to the financial institutions in the form of interest. And that's the name of the game for them. They want you to deposit your money as often as you possibly can. They want to keep it as long as they possibly can. And then they don't want you to take it back, right? So, and they want to utilize your money to create loans to other people and to create loans to you. And so how can we battle that so that we then are the folks that that earn the interest on our money, rather than always the financial institutions that really don't even have any liability other than making sure they pay our deposits back. They're just making money on other people's money. So that's the major one. That's the number one that Becoming Your Own Banker addresses the most, but it's not the only one. And I don't even know if it's the most important or if I think they're all pretty equally weighted in some ways.
Yeah, I would give the first two a much greater weighting as far as how much we need to counter them. The
Yep.
corporations, the third one, they're trying to they want your money, but they want it generally in a free exchange of commerce. Now there is a lot of issues with the oligarchical corporatism kind of state that we have, where companies do the bidding of the government, things that the government's not legally allowed to do, uh, like closing down businesses. They just do it through corporations, and those corporations, the big ones, set the tone. So there is a degree of malintent there, but that's kind of a broad umbrella.
I think before you leave corporations, I think that one of the reasons is really anything they're doing. Well, not anything, but a big part of what they're doing in the way that our money flows in that free exchange, even in the market we have, is they have to pass all of the costs that occur due to the financial institutions and the government onto the final customer. So that's kind of like really piece number one and piece number two here that we're playing against, or institution number one and two, financial institutions and government, create the reason that corporations are a big player. So really, it's one and two that crush us, I think.
Yeah, for sure. And government being number two there, kind of jump to three. But the tax burden is the biggest problem that wealthy people face. It's not there is a lot to talk about, and we'll do a future episode on taxes, but the tax guide is a roadmap, and it incentivizes behavior. So it's not just this we're in our general ideology, we do believe that income tax is illegal and that the entire tax system should be abolished as it stands today. But it's not going to be, and so we play within these rules. And a lot of the conventional model, you're trying to gain this small rate of return, you're trying to optimize, making these big moves, taking on more risk to go from maybe 6 or 7% up to 9 or 10% return. But the whole time, the government doesn't have to try at all to take 22%. And hopefully, we all want to be in a 40% tax bracket because that means that we are earning more income. I can't wait for the day I'm in a 40% tax bracket, even though that makes me cringe. But uh, the government doesn't have to try to take a quarter of your money. They get to automatically unless you can strategically reallocate your assets to avoid that vampire that's always going to be there. I think the government is of these three is the biggest vampire. The financial institutions are fed by that.
Yeah, I mean, what's wild is what you're talking about too is just what the federal government takes. And if we look at taxation in general, so we want to optimize that because the taxes don't even stop there. Everybody talks about, yeah, I'm in a 20% tax bracket or whatever. But like here in Pennsylvania, we pay a little bit over 3% in state tax. You're in California, which is, what isn't it, like 10 or something like that? State income tax?
I've
13?
been well. I've been military my entire time living here, and so I've never had to. I maintain Texas residency, so I actually don't know. I get out of the Navy next month, and I will quickly find out and report back
Yeah,
to you.
but I think California's high. I don't recall, but then
Yeah.
it's like every time you go to the gas pump, tax. You open up your car bill. I mean, I'm sorry, your phone bill, tax. You go to the airport. There's an airport tax. You got property tax. You got taxes everywhere. So the real number is, I bet it's north of 50% of your income goes to the government in some form or another, or in taxes of some form or another. So if we could find a way to optimize that part that the tax code's built around that federal income tax, we can keep a lot more of our wealth.
And I can give a very painful and timely example. When you're in the military, a lot of your paycheck is tax free, primarily your housing allowance, and that scales to your zip code. And so I live in a very expensive zip code. I look at my take home pay in the Navy right now when I'm not taxed on my income because I'm a Texas resident, and I have a big chunk, my housing allowance, big chunk of my income is tax free at the moment. There's calculators that you're separating going through that process where they show you essentially a civilian equivalent of what you have to make in order to have the same take home pay. And I have no problem talking numbers or specifics on here. I don't want to ever shy away from making a point for that. So I'll just say in the Navy, as my rank as an 04 in Coronado, California, you're taking home about 150,000 a year. In order, once I no longer have the benefit of not being a Texas resident for income tax purposes, and I'm no longer having a tax-free housing allowance, I have to make 245, I believe was the number, $245,000 to have the same take-home pay that I had before, and that is 100% due to taxes. Talking about the state income tax, and I'm talking about the tax-free benefit that I get for housing that we get in the military, and so this government, the entire additional nearly $100,000 that I have to make to have the same standard of living is entirely due to the government on the other side of the chessboard. That is a very painful and coming at me like a tidal wave realization. And so, what we need to do and what we want all of our members to do and people that are interested in working with us is reallocate things to slay that dragon as effectively as we possibly can.
Yeah, man, and that doesn't even mention the monstrosity that Obamacare was that you're about to face as you leave the military healthcare system. But that's a whole nother topic. Let's
I can't.
let's
Yeah, I can't even. That's. Um. Yeah.
so really talk about probably 265,000 once you start adding that in.
Yeah. We either have to pay maybe $15,000 a year for. We don't use the medical system, so for a product that we don't use at all, don't trust, we have to either pay. I have to figure out what makes more sense to just pay for a healthcare policy that I don't need, or to take the tax hit. It's absolutely retarded, and I can't even begin to describe this state as half illegals, and none of them have to. All get healthcare without even paying a dime in tax, and I'm trying to figure out: do I pay the $15,000 for something I don't need, or do I take the tax hit? It's insanity, and you might be asking why you live in California. There's a longer story there, and it's not a long term thing for us. But anyways, I don't want to derail anymore.
Well, let's get back on track then. So I'll just you can keep going. What did these do? So we've talked about the three institutions that are the major players against us that we're working against. We want to build wealth: financial institutions, government, corporations. What do they want from you? I've kind of touched on it already with the financial side, but I'll let you go ahead and go into depth on that.
Yeah, simply put, they want your money for as long as possible on a systematic basis. And when it's time to give it back to you, they want to give back as little as they can. So, what that means is you are providing all of the capital and assuming all of the risk. You're delaying your enjoyment of life today for a promised tomorrow in the net worth versus cash flow mindset.
Yeah, and I think the perfect example of those things, them wanting your money for as long as possible on a systematic basis, and they want to keep it as long as possible. The thing that most adult Americans are now familiar with, that almost perfectly defines that as the qualified plan, whether that's a 401k, a TSP, a 403b, was there 427? There's all kinds of them now, depending on what kind of entity you work in or how free the market is of your place of employment. But it is exactly that. If you think about it, they want your money. They automatically, they try to get you to do automatic deductions. They want it for as long as possible. If you're 25, they want to keep it until you're basically 60. It's 59 and a half until you can access that. They want you to do it every single time you get a paycheck. They want more of the money. And then they want to give you slow systematic withdrawal. There's all kinds of rules about keep your money here and take a certain percentage of it. So it fits that definition perfectly, and all of them. And that's the marketing side of it. That's what we always hear about. That's what everybody tells. Save, which is the wrong term. Invest your money, you gamble with your money into these qualified plans. And there's trillions of dollars in them.
Yeah, in one of my classes in grad school, it was about essentially market manipulation and behavioral psychology. And so one of the celebrated instances they talked about, which I agreed with at the time, was that in the behavior modification field, when they made it so that you're automatically opted into a 401k, well, savings rate increased and retirement savings increased. And that makes sense because you remove that barrier, you remove that friction. We're talking about on a systematic basis. We're removing the friction there, and everyone opts in automatically, and you have to opt out. So yes, more people are going to opt in. And when I'm back in my previous kind of Dave Ramsey conventional financial planning mindset, I was like, yeah, that's a great thing. That's excellent news. I'm so glad that that's happening. But that's kind of a junior varsity level, rice and beans understanding of economics. And so now looking at it from the cash flow perspective with a little bit more clarity on what the banks are trying to do, yeah, it makes perfect sense. And so if you're on that rice and beans chessboard, that might seem like a great move for you. You're automatically saving for retirement, quote, investing for retirement without thinking about it. But who's the other player? In this case, the financial institution is on the other side of the chessboard. They're making a varsity move and you're making a JV move. And if that's if that's all you know, if that's your best knowledge to that point, then yeah, it's might have been better than what you're doing before. But when you understand the motivations and the incentive structure on the other side of the board and what they're doing, it's not this benevolent behavioral modification for your advantage. There's a reason they want that capital.
Yeah, and if you tie that, you're talking about the corporation there. If you tie that all the way back to the very first thing we discussed, which is the big three: the financial institutions, the government, and the corporations. What do the corporations get to compel you to play this game? And not only that, but Social Security fits the same thing. The corporations are incentivized to have you put money into these institutions because they're getting a tax write-off on any match that you get. Same thing on their side. Like, a lot of people don't realize you're paying into Social Security, which I think is another topic we can hit more broadly or get more granular on. But you're paying the 6.2%. They also are paying that same amount, 6.2% on the other side of that. So it's really 12.4% of your income, if you're a wage earner, gets paid into Social Security. Well, the corporation gets to write off their end of that. And so when you think about it, when a person thinks about their total compensation, it almost feels like your total compensation is more than your salary. Those benefits are part of your total compensation, but the corporations are getting a big tax break to do those things. I don't fault them for it. It's a great thing, but it just shows how much manipulation there is between the government and the financial institutions who are tied together at the hip in many ways.
Yeah, and it brings back that quote. We talked about, all right, the varsity level opponent that you're playing, sitting on the other side of the board, being the financial institution. On the other side of the table is also the government, and so what they're doing in the same exact move, that while the financial institutions move their piece to try to get you to put your money in a systematic basis, that's also a great move for the government. And the Nelson Nash quote is, when government creates a problem, i.e., onerous taxation, and then turns around and grants you an exception to the problem they created, i.e., any qualified plan, aren't you just a little bit suspicious that you're being manipulated? That's such a phenomenal point, and so many people don't make that connection. And a lot of, like, we are, and a lot of our members are, and people in our that we relate to and interact with are generally pretty distrustful of the intentions of the government. But there is people don't bridge the gap to, well, the same people you don't trust with the COVID hoax. They're it's the same people that are doing this as well. Like, if we think broad picture, the government, they just faked a pandemic on the world and shut down the economy and all of the insanity of the last 4 years. They're also creating this problem, onerous taxation, and giving you this little crumb. And so that is their move, and it fits in with the analogy of the chess move that they're doing as the government. So we called this at the beginning, we talked about the Stockholm Syndrome. So where does that come from? I'm just going to assume that people are familiar with the term Stockholm Syndrome and sympathizing with your captors. And so far we've covered who are the three people, the three institutions, we've covered who are the three entities sitting across the chessboard from you. But why are we talking about Stockholm Syndrome? The reason is because when we talk about infinite banking, we don't get any pushback from the financial institutions. We don't get any pushback from the government. In fact, the government, through the tax code, incentivizes people to do IBC. They just don't broadcast it. Again, going back to the tax code as a roadmap of how to avoid taxes, the reason this IBC system is so powerful is partially because there are so many tax benefits. So it's not the government telling us not to do IBC, and it's not the financial institutions. There's hundreds of billions of annual marketing expenditure in the financial world, but you never hear them castigating IBC or whole life. The people where we get pushback from is people who are playing the game and losing to the government and to these institutions. So the most aggressive defenders of the interests of the financial institutions, our people are people who are using their products and playing the game exactly how those entities want the game to be played. Does that make sense? Am I tying this together?
Yeah, that makes total sense. Yeah, absolutely. Now, I will say, and I think we have a little bit of a difference of opinion here at this point, but surprisingly, we're business partners who aren't perfectly aligned. I think that a person should take advantage of their qualified plan up to the match, because that's money that is part of your compensation that your corporation is either going to just keep if you don't take the match, or they're going to get the tax break. But either way, they're going to benefit if you don't take it. So you might as well at least get the match. And I wouldn't put a penny more personally. I put zero in because I don't get a match with as my reserve career in the military comes to an end here. But that's the extent of it. I think Hans, you're a hardcore $0.
I am. I've walked through it with someone, and basically, all right, yeah, you could get the match, and at a very surface level, you could call it, you put 5% in, they match you 5%, you're getting a guarantee. If we put that, if we do an example where we put that exact same money into premium, and then we look at what that does beyond just the compounding of that money specifically, but the many multitudes that it yields in death benefit for your family, I think you can make an argument that it's not just a free one for one, or if it is, it might not be the most optimal. I don't have a problem with someone doing that. And if we have people that work with us who want to keep getting that match, we're not telling you not to do that. And I understand going up to the match line. It's more just philosophically, it's going back just to the fact that you are playing their game, and going right into the maneuver that they want you to be in, and you are fulfilling that desire they have of your money for as long as possible on a systematic basis. So this plan as a whole, I don't think is a good thing. But can you optimize and get 5% quote free? Sure, I buy that.
I don't even think it's so much as the free. I think that when you look at whatever value you're bringing to the company, that's a part of the negotiation process that you don't even get to be a part of because it's usually some contractual thing. So you are, if just to use easy numbers, if it's $100,000 that they're going to pay you, and they match 5%, you're actually worth 105%, but they're going to withhold that 5% to get some kind of perk on their end. Either they're going to get a write off on it or they're going to keep it. So that's what your real value is. So part of me is like, I want to take that somehow. I think I should get that compensation that my labor is worth to whatever this company is as a W-2 employee.
Right. And I think you could kind of, if you want some validation of what we're saying, you could ask your employer, say, hey, you're going to match 5%. Why don't you just give that to me to put into premium or to do what I want to with it? And I don't think they would. And there's a reason for that.
Yeah. And that's because usually they're contractually obligated to match once they've set that in motion, and they want the benefits on their end. Anyway, which is, I don't blame them. I don't blame the company you work for. I love capitalism. Nobody ever works for anybody poorer than them. It's all good.
Yeah. So overall, to kind of sum up the idea of why there's a problem here is that there is widespread agreement in strategy between consumers and the institutions that desire their money. And again, that gets back to the cash flow versus net worth and which game are you playing. Consumers generally that are doing this plan are delaying use and enjoyment of their capital today for a promise of more enjoyment in the future.
And it's not, I don't even think it's a good promise, because I think a promise is something that shouldn't be broken. It's really more for the hope, which is a losing strategy of having a better future. So you give up all that now, hoping that this is going to work out. But while we're on the topic of this 401k stuff, like there's a lot of unknown variables that, we talk about a lot of times with clients is, what is your tax rate going to be when our country is it 34 yet billion dollars or trillion dollars, excuse me, in debt? I wish it was billions. $34 trillion in debt, running a deficit. Are the taxes going up or down? So if you're 35, do you think your taxes will be the same? A lot of folks pitch that you'll be in a lower tax bracket when you retire. And that's where the incentive is here, because you're getting this tax incentive of deferred taxes now when you deposit into these qualified plans. And then in 30 years, you're going to be in a lower tax bracket. But do you think taxes are going to be the same, or do you think they're going up or down? Like really, really sit and think about that based on the financial trajectory of our country.
Yeah, and I'm not going to roll that dice.
Yeah. And so you're giving up the money now, the cash flow now, the possibility to use it, as we teach in infinite banking, that we can have our dollars working in multiple places at the same time in order to get some dream, some hope of having a good opportunity down the road. Doesn't make a lot of sense.
Yeah. So if you're listening to this, I would ask, thinking of, as we've laid out what the goals are of these three entities, do you believe that your incentives are aligned with theirs? I would say no. I think it's a pretty easy no. But then I would ask the second question, is your current strategy aligned with their incentive? And if you're doing their plan, then it is. So
Most people's are.
You have conflicting incentive structures here. And do you think you're going to beat them? Do you think that with their knowledge, cutting edge technology, marketing budget, and the government on their side, do you think you're going to win in this battle of conflicting incentive structures? I don't want to be on the other side of that when I don't have to be.
And even before that, I think, and hopefully you're here listening because you want to learn more about infinite banking and more optimal ways to use your money. But most of us just don't know that we are playing the game against who we're playing and the way we're playing it. So it's really a story of ignorance. You have conflicting interests or conflicting incentives. However, you don't even realize that you're playing it on their level in their game. So now you know. So we can start thinking about this.
Yeah, and the way that I came to this, the way that a lot of people come to it, approach an issue as if you have no opinion on it at all, and just reassess any prior assumptions. that is critical thinking. And I have been for my entire life, like I've mentioned briefly in a previous episode, I've been doing the traditional financial planning. What I always thought was, it was the best I knew how to do at the time. But I now look back and realize that I was not acting optimally.
Yeah, and one of to fit what you're saying, one of Nelson Nash's main principles that he added on later was to rethink your thinking, and constantly be willing to rethink your thinking, because you may think you know where you are, you may have critical thinking about things, but it doesn't mean it's right. You can be thinking in the totally wrong direction for a long time until something smacks you in the face and redirects you and makes you and go, oh wow, I didn't even know what was out there outside of, I was on this little island of thought, and there's so many other ways to think. So rethink your thinking. I mean, I don't think Nelson could say it enough. I don't think we can say it enough. We constantly need to be challenging what we believe.
Yeah, and that was easier for us going through what we went through, and we'll talk about our stories in depth a bit more on future episodes. But in short, Brian and I met through fighting the DoD's COVID vaccine mandate, and we both refused it. And through that journey and that battle with the DoD, came to a totally different understanding of the medical system, a totally separate industry. However, applying that same lens of healthy skepticism and being willing to rethink our thinking, this showed up as the economic front of that larger battle. And so, kind of a summary quote to tie that all together from Patrick Donahoe is: "Do what the banks do, not what they tell you to do. They're not doing what we are told to do. What they're doing is they're not doing IBC per se, but they are using the same strategies that IBC mirrors. We're cash flowing, we're taking control of the banking function, etc. And so do what the banks do, not what they tell you to do." And that's from his book, Heads I Win, Tails You Lose.
Yeah, the banks are cash flowing money. They're moving money constantly. It does not sit stagnant in their institution, but they want our money to sit stagnant in their institution. So somehow your money should be flowing and being used all through your life. Nelson talks about in his book, it's just like blood, it's just like water. When it stops, you die. Or when, stagnant water stinks. Same thing with your money. So stop being a passenger in your family's financial future. Boldly take control of your wealth.